Dear friends, welcome to Investing Now, a channel where you can find fundamental analysis on companies. And today I propose to make an analysis on Texas Instruments. What to say about Texas Instruments? Well, it designs and manufactures semiconductors and integrated circuits. It's headquartered in Dallas, Texas. It has a broad portfolio of analog and processing products. Its applications are automotive, industrial, communications, consumer electronics, and others. And some of the most notable products include microcontrollers, digital signal processors, analog chips, and power management integrated circuits. All over the years, Texas Instruments has maintained a strong presence in the semiconductor market and continues to be a major player within the industry. Let's proceed with the analysis, and as usual, I like to start with an overview on the company, followed by key figures on income statement, balance sheet, cash flow, the estimation of the intrinsic value, and finally the key points on the company. First, I would like to share the value increase of Texas Instruments in the last 5 years. And as we can see, the value has increased by 63%, which means that on average, the value of Texas increased around 12% yearly. This is below than its competitor Analog Devices, in line with Infineon Technologies and ahead of Micron Technologies. So what to talk about Texas right now? Texas is going to present its second quarter results on 25 of July, and according to some analysts, it's expected that the earnings per share that will be reported will be around 1.76, which is considerably lower than the value registered in the same period of the last year, 2.45. This is in line with the guidance that was shared by the board in the last quarter, that the earnings per share would be between 1.62 and 1.88. So let's see tomorrow what's going to happen in the second quarter results. And based on these initial insights, I would like to try to make sense about Texas Instruments. So as usual, I like to start with the size of the company. Texas Instruments has a market capitalization of 166 billion US dollars. It's a large cap company. The number of employees is around 33,000. The value of the beta is 1, so means that the price evolution is going to be aligned with the market. In terms of ratios, price to sales is 9, in line with the average of the industry. The price earnings ratio is 21, a little bit lower than the average of the industry, and the price earnings growth ratio is 3.78, considering a growth of 5.5%, which is ahead of the average of the industry. Looking at the income statement, we can see that the revenue has increased from 2016, exception year for 2019 and 2020, and currently in the last quarter, March 23, the value of the revenue was lower 10% than in the same period of the last year. On the other hand, the net margin of Texas is very, very high, 42%. Which is way ahead than the average of the industry. In terms of revenue per employee, the value is a little bit lower than the average of the industry, but in terms of net income per employee, the value is considerably higher. And as we have seen, on average, the growth over the last 6 years was 5.5% and last quarter minus 10%. Here on balance sheet, I would like to look at the evolution for the total debt, and as we can observe, the total debt has increased from 2018, also in line with the evolution of total assets. In terms of ratios, market cap to book value, the value is around 11, a little bit ahead than the average of the industry. The ratio between total liabilities and total assets is 50%, higher than the average of the industry. In terms of total liabilities compared to total revenue, the value is 75% lower than the average of industry, which is okay, a good indicator. In terms of debt to equity, the value is higher than the average of the industry, but when we compare to the debt to net income, the value is considerably lower than the average of the industry. Looking now at the cash flow figures, we can observe that the net operating cash flow was increasing from 2020, but on the last quarter, the value was lower when compared to the same period of the last year. The free cash flow to equity and the free cash flow were more or less aligned. Of course, the free cash flow to equity was higher due to the issuance of debt. In terms of cash flow margin, the value is higher than the average of the industry. The same situation here for the ratio between the net operating cash flow to sales. And in terms of debt and total liabilities, the free cash flow to total liabilities is the ratio is higher than the average of the industry. Also, the same situation here for the cash flow coverage, which is a good indicator, meaning that the money that is being generated by the operations has some margin to cover the total debt. In terms of capital expenditure evolution, the value has increased from 2020, also increased here in the last quarter when compared to the same period of the last year, which is a good indicator, meaning that the company is proceeding with its investments. In terms of efficiency on investments, the return on capital employed compared to the average cost of capital is 4.4 times, way ahead than the average of the industry. In terms of dividends policy, the payout ratio is around 50%, and currently the dividend yield is 2.6%. In terms of valuation ratios, we can observe that the average values are lower when compared to the average of industry. This is true for price to EBITDA, price to free cash flow, and price to free cash flow to equity. In terms of profitability, the ratios are considerably higher than the average of the industry. The same situation here for liquidity, and the level of debt when compared to net operating cash flow is 1.8, meaning that we would need more or less 2 years to pay the total debt with the net operating cash flow. If we compare the ratios between Texas Instruments and its competitor Analog Devices, we can see that in terms of valuation, the situation is more or less the same for both companies, but in terms of profitability, the ratios of Texas Instruments are much higher when compared to Analog Devices. In terms of liquidity, also the situation here of Analog Devices is not as good as the situation on Texas Instruments. Let's estimate now the intrinsic value, and for this purpose I've selected a scenario called low growth. This is a conservative scenario. In terms of cost to equity, the estimated value is 9.5%. CAPM estimates the value of 10.1%. The cost of debt is 2.4%, which results on an average cost of capital of 9%. In terms of ratios evolution, the PE ratio currently has a value of 21, and over a period of 10 years it will decrease to values around 9.8. This is the same for price to sales, price to free cash flow, and the price to free cash flow to equity. These are my forecasts for revenue, EBITDA, net income, free cash flow to equity, and earnings per share, based on the selected scenario. And as we can see, on average, the revenue is going to grow at 2.5% a year. And here are the results for the intrinsic value. Currently, the price is 184, and my estimations for the intrinsic value are around 130. Of course, I was conservative in my considerations about Texas Instruments. Nevertheless, the difference shows that the company is probably overvalued. These are the considered evolutions for the ratios on the left and the resulting price estimations over a period of 10 years. Here we can observe the price evolution over the last 10 years, also the weighted average of the last 3 years, weighted average of the last year, and the weighted average of the last 200 days. And as we can observe, the price never goes below, or at least way below than the average, weighted average of the last 3 years. And currently the price is a little bit higher than the weighted average of the last 3 years. Finally, the key points on Texas Instruments. In terms of guidance, Texas is going to report its second quarter results on 25 of July. And according to some analysts, it's expected to report earnings per share of 1.76, which is considerably lower than the value reported for the same period of the last year. In terms of valuation, according to my estimations, the company is probably overvalued. Of course, I was conservative in my forecasts, but on the other hand, it has lower valuation ratios when compared to other companies within the same industry. So the question is the industry as a whole overvalued? That's a question that we should consider if we decide to invest in Texas Instruments. In terms of profitability, I consider it to be a premium company with very, very good values. Also, Texas Instruments has shown financial stability over the years. And of course, Texas Instruments puts a lot of effort in research and development, which means that in the future, we should expect that this investment will release value for the company. In terms of strengths, I would say that the Texas Instruments has a diverse product portfolio that tackles industries such as automotive, industrial applications, communications, and consumer electronics. Also, it has market leadership in specific product categories. The R&D capabilities allows Texas Instruments to introduce innovative and advanced products in the market. It has global presence, both on operations and sales, and historically has shown strong financial performance. In terms of weaknesses, I would say that Texas is dependent on specific markets such as consumer electronics and automotive. Also, this is a highly competitive market that will put pressure always on prices and profitability. And semiconductor business is also subject to technology cycles. And so it's mandatory to stay innovative to be competitive. In terms of opportunities, I would identify IoT and 5G implementation as opportunities to grow business of Texas Instruments. Specifically, I would identify smart homes, wearables, and industrial applications regarding IoT as key markets for Texas Instruments. Also, automotive electronics and renewable energy will make a lot of use of Texas products. And finally, in terms of threats, I would say, and this could be applied for every company, but economic conditions could affect negatively the performance of Texas Instruments. Also, geopolitical tensions that can create restrictions on sales in specific products, specifically semiconductor products. Since this is a very competitive industry, the technological disruptions can rapidly change the business for Texas Instruments. And finally, intellectual property challenges is always that these kind of companies should be prepared for. And this was my analysis for Texas Instruments. I hope that you have enjoyed my views about the company. And if you have any comment, please leave it below. And in the meanwhile, I'll be working in the next video. Thank you very much.